Ind AS 33, Earnings per Share, from Basic to Diluted, Fully Explained. Welcome to Candy Mentor. Today we're unpacking Ind AS 33, the standard that governs earnings per share, EPS, one of the most closely watched measures of profitability per equity share. We'll move step by step, starting from the basic EPS logic, and gradually build up to the more advanced concepts like dilution, convertibles, and potential shares. 1. Objective and importance. Ind AS 33 aims to make EPS reporting consistent and comparable across companies. EPS tells investors how efficiently a company's profit is being shared among its ordinary shareholders. It matters because analysts and investors use EPS for valuation ratios like the price-to-earnings (PE) multiple, comparing profitability trends over time, and communicating performance transparently to markets and boards. In short, EPS standardizes how we express profitability, regardless of company size or industry. 2. Scope and applicability. The standard applies to all companies that have ordinary shares traded publicly or are in the process of listing. Unlisted companies may also disclose EPS if they issue ordinary shares, and it's considered a good governance practice. It does not apply to entities without share capital, such as mutual funds or partnerships. EPS must be shown for both consolidated and standalone financial statements. 3. Core concept: what EPS really means. EPS measures the profit available per ordinary share of equity, essentially the earning power per share. The calculation involves two main parts. First, the numerator, profit after tax, adjusted for preference dividends and other items. Second, the denominator, the weighted average number of equity shares outstanding during the year. For example, if a company earns 10 lakh rupees with 2 lakh shares outstanding, EPS equals 5 rupees per share. If more shares are issued without increasing profit, EPS drops, showing dilution. That's it. 4. Types of EPS under Ind AS 33. There are two types of EPS. First, basic EPS, which uses only the existing shares. Second, diluted EPS, which includes possible future shares from convertible instruments or options. If such potential shares exist, both must be presented and with equal prominence in financial statements. End. 5. Basic EPS. Concept and formula. The formula for basic EPS is simple. Basic EPS equals the net profit attributable to equity shareholders divided by the weighted average number of shares outstanding during the period. It represents the true earnings per existing share after paying preference dividends. We also adjust retrospectively for share splits, bonus issues, or rights issues to maintain comparability. 6. Numerator, profit for basic EPS. Start from profit after tax and make these adjustments. Deduct preference dividends, whether declared or cumulative but unpaid. Adjust for any premium or discount on redemption of preference shares, and consider post-tax effects of discontinued operations or prior period errors if shown separately. The final numerator should represent profit belonging to ordinary shareholders from continuing operations. 7. Denominator, weighted average shares. The denominator reflects how long each share existed during the year. We multiply the number of shares by the time fraction for which they were outstanding. For instance, if 1 lakh shares existed for 6 months and 50,000 new shares were issued for the next 6 months, the weighted average number of shares becomes 1,25,000. Always adjust retrospectively for any bonus issue, share split, or consolidation. Sentence. 8. Bonus issue, share split, and consolidation. Bonus issues are treated as if the new shares existed from the start of the period. For example, a 1-for-1 bonus doubles the number of shares, and therefore the EPS is halved retrospectively. A share split reduces the nominal value of shares but increases their number, while a consolidation combines them into fewer shares. In both cases, we adjust EPS retrospectively to ensure consistency. 9. Rights issue adjustment. A rights issue may include a bonus element if shares are issued below their fair market value. To adjust, use the formula fair value before rights divided by the theoretical ex-rights price, known as TURP. If the fair value before rights is 120 rupees and the TURP is 100 rupees, the adjustment factor is 1.2. Previous EPS must then be divided by this factor to restate earlier years. 10. Example. Basic EPS calculation. Here's a quick illustration. Profit after tax is 15 lakh rupees. Preference dividend is 1 lakh rupees. That means net profit available to equity holders is 14 lakh rupees. Weighted average shares equal 2,80,000. So basic EPS equals 5 rupees per share. If a 1-for-1 bonus is later issued, shares double and the restated EPS becomes 2 rupees 50 paise. 11. Diluted EPS. Concept. Diluted EPS shows what happens if all potential equity instruments, such as convertible bonds, warrants, or stock options, were exercised. It gives investors a worst-case EPS scenario, assuming more shares but the same total profit. Conversions are assumed to occur at the beginning of the year or on the issue date if later. That is our next topic. 12. Diluted EPS. Formula. The formula for diluted EPS is adjusted net profit divided by weighted average shares plus potential shares. To adjust the profit, add back interest on convertible debt, net of tax. Add back preference dividends on convertible preference shares, and adjust for any group-level impact on associated companies. To adjust the number of shares, add all potential shares that would arise from conversion, but include only those that reduce EPS. 13. Potential ordinary shares, POS. Potential ordinary shares include convertible bonds or debentures, convertible preference shares, warrants, employee stock options, and contingently issuable shares based on performance conditions. Only include those that reduce EPS. Exclude any that increase it. So, 14. Identifying dilutive versus anti-dilutive instruments. An instrument is dilutive if its conversion reduces EPS. It is anti-dilutive if conversion increases EPS. A simple test. If diluted EPS is lower than basic EPS, include the instrument. If it is higher, exclude it. Example, if basic EPS is 8 rupees and after conversion it becomes 7 rupees 50 paise, include. If it becomes 8 rupees 20 paise, exclude. Example, convertible debenture profit after tax is 12 lakh rupees. The company has 1 lakh shares and 10 lakh rupees of 10% convertible debentures, each convertible into 20 shares. Tax rate is 30%. Step 1. Add back after-tax interest. 10% of 10 lakh times 1 minus 0.3 equals 70,000. Step 2. Add 20,000 potential shares. Step 3. Adjusted profit equals 12 lakh 70,000. Step 4. Diluted EPS equals 12 lakh 70,000 divided by 1 lakh 20,000 shares, giving 10 rupees 58 paise per share. End. 16. Employee stock options, Treasury Stock Method. For ESOPs, assume all options are exercised at the average market price. The company then uses the cash received to buy back some shares at that same market price. Only the net new shares remaining after this notional buyback are treated as dilution. Example, 1,000 options at 100 rupees each, and the average market price is 150 rupees. Proceeds equal 1 lakh rupees, enough to buy back 667 shares, so only 333 shares are treated as new. 17. Contingently issuable shares. These are shares that will be issued only if a performance or market condition is achieved. For instance, shares issued if profit exceeds 10 crore rupees. Include them in diluted EPS if the condition is already satisfied on the balance sheet date. If not yet met, disclose them separately as potential dilution. 18. Step-by-step summary for diluted EPS. Here's the full sequence. Step 1. Calculate basic EPS. Step 2. Identify potential shares. Step 3. Adjust profit for interest or preference dividends, net of tax. Step 4. Add potential shares to the denominator. Step 5. Recalculate EPS. Step 6. Include only if the new EPS is lower than basic EPS. Finally, present both figures on the face of the profit and loss statement. 19. Presentation in financial statements. Both basic and diluted EPS must be shown clearly on the face of the statement of profit and loss for both continuing and total operations. If there are discontinued operations, show a separate EPS for that segment. Restate prior periods when share capital changes significantly, such as during a bonus issue. And 20. Disclosure requirements. Companies must disclose basic and diluted EPS along with reconciliations. First, reconcile the profit after tax to the adjusted profit used for EPS. Second, reconcile the weighted average shares to the diluted share count. Also, list instruments excluded as anti-dilutive and disclose any material share-related events after the reporting date. 21. Relation with other standards. Ind AS 1 requires EPS to appear directly on the P&L statement. Ind AS 10 requires adjustment if share capital changes materially after reporting. Ind AS 102 covers ESOPs, which affect potential dilution. Ind AS 32 and 109 define the classification of convertible debt and preference shares. End. 22. Common mistakes and pitfalls. Be alert to these common errors. Forgetting to deduct preference dividends in basic EPS. Including anti-dilutive instruments in diluted EPS. Ignoring retrospective adjustments for bonus or rights issues. Misapplying the time fraction when calculating weighted average shares. And skipping reconciliations in EPS disclosures. 23. Audit and analyst focus areas. Auditors and analysts often recheck EPS carefully. They verify conversion assumptions, recalculate EPS independently, confirm restatements for bonus or rights issues, and ensure only truly dilutive effects are included. They also match reconciliations with the disclosures in the notes to accounts. 24. Real-world example. Infosys Limited, year 2024. In the year 2024, Infosys reported a basic EPS of 67 rupees 90 paise and a diluted EPS of 67 rupees 75 paise. The tiny difference shows limited dilution, mainly from employee stock options. This suggests stable profits and a strong, consistent capital structure. 25. Key formulas recap. Let's summarize the core relationships in words. Basic EPS equals net profit minus preference dividends divided by the weighted average number of shares. Remember to restate for any bonus or rights issues. Diluted EPS equals adjusted profit divided by the total of weighted shares plus potential shares. When calculating adjusted profit, add back any interest or preference dividends from convertible instruments. Rights issue adjustment equals fair value before the rights issue divided by the theoretical X rights price. Use this factor to restate EPS for prior periods. 26. Quick decision guide. Here's how to decide which EPS to show. If a company has only ordinary shares, calculate basic EPS. If it has convertible debt or preference shares, calculate both basic and diluted EPS, including potential shares. If it has bonus or rights issues, restate previous EPS to keep figures comparable. And if it has discontinued operations, show EPS separately for continuing and discontinued parts of the business. End. Closing summary. In short, basic EPS shows the profit earned per existing share. Diluted EPS shows what profit per share would be if all convertibles turned into equity. Together, they give a complete picture of profitability and potential dilution. Accurate and transparent EPS reporting strengthens investor trust and improves comparability across companies. And that's your full walkthrough of Ind AS 33, earnings per share. From the basics all the way to dilution.